Hi, folks. This is Sean Hyman from Logical Investor Newsletter, and want to start off this week by still looking at the long-term chart of the S&P 500. You've still got this kind of like a rising wedge. You could draw it kind of a couple of ways, but this first way I drew it was probably the most accurate. But these are also known as ending diagonals, which are the ends of trends as well. Now you can get spikes and hooks up out of these, temporarily and before heading lower. So that can happen. I'm not saying it can't, but you've had RSI steadily lower, MACD steadily lower, lots of selling volume picking up, price way away from the 200-week moving average. The price is in the top Bollinger Band, which increases risk. The average PE on the S&P 500 right now is roughly about 23. So anything around 20 to 25 is way overvalued, potential crash level type situation. Doesn't mean it has to, it means it carries extreme risk. So looking back, go back, let's see. Let me go back some to like 1995. So you had the market zipping up here was overvalued, far away from the 200-week moving average, and this happened from 1553 to 768. You had it rush up again, gets very far extended away from its 200-week moving average after a mature run, and has this three-wave massive correction from 1576 to 666. Now we've had longest bull market run in U.S. history, mature run, far away from the 200-week moving average. 1, 2, 3, 4, and then we're still in like a fifth, which is this wedge here with the declining RSI and MACD and increasing selling volume, price in the top Bollinger Band. So we are at risk of this happening again. And, a lot of times people think, well, the big corrections, big crashes type things can't happen. And they didn't think that when this was happening, they didn't think this could happen. And when this was happening, things have been going along so good, they didn't think this could happen. And when this has happened, look at how long and pronounced that is. Of course, they feel even more strongly that, something like, that can't happen. But trust me, it can happen. One of the only ways you get PE valuations from 20s back to teens and possibly even single digits before it's over, single digits to 10 or 12 PE before it's all said and done, is you got to have stocks, fall faster than earnings and get those PE levels down. So, so that's coming. Nobody knows the exact timing of that. But we all know, we can all know when risks are there, and somebody could, play with fire and trying to catch the top, and that's what most investors are trying to do. But you can easily find yourself getting caught up in a 2000 or 2008 situation where you have market crashes. So how have I always avoided all the market crashes? Granted, you forego some of the top by doing that, but you avoid massive risks. And to me, the job of the professional investor and the job of the prudent steward is to be wise in stewarding their assets and being in investments when they are low risk, low PE, etc., and when sentiment is bad, and being out of them when risks are high PE, overly exuberant, sentiment, things of that sort. So if the market popped hard up here first before coming back down, what does that still mean? It still means it just went from more overvalued to even more overvalued. So does that make it more desirable? Well, if you're thinking right, it shouldn't, because it would be like Housing went up in 2007 to, mid 2007, from 2006 to 2007, quite a bit. So therefore, should you run out and buy a house or get a second house because of it? No, because 2008 was coming and it was a massive, massive downturn in the housing market due to overvaluation. So overvaluation doesn't feel overvalued and doesn't feel risky when things are going up. But when things are going up does not mean that there's any less risk. It's just it's realized once it's happening. And when it's unfolding, it can unfold fast. I mean, just a quick reminder how this went from 29.40 to 23.46 in about a blink. So that's how fast things can unravel, and that's with it still holding its 200-week moving average. Imagine when that doesn't. Well, we're just as stretched again, because this has moved up, so has this moved up. So we're just as stretched again as we were from this last unraveling here when institutions were hitting the sell button very strongly. And so there's just as much risk out of there right now, whether it goes up or down. So don't be confused by that. Also realize too that we are making money prudently in values without having to take on excessive valuations and extreme risks. So, but the S&P is at the top of a Bollinger Band on daily and weekly. It's overbought daily and weekly. It's having sell spikes. This MACD is still heading lower. RSI is still heading lower. So those are not good signs when you have stuff like that. And then of course MACD has been low for a while as well. And again, could it break above that and get some euphoric something before heading lower? Absolutely. But do we want to be in on that? I mean, what else in life do we jump at buying overvalued? Like if you felt a coat was overvalued or a t-shirt was overvalued, would you want to be longing to run out and buy it? No. But for some reason people love doing that in stocks, and it's just the weirdest thing. So and price is not always reflective of value. So let me just see if I can do an example of that. So let's say that you've got a jacket, and here's the baseline for the jacket. And the jacket, let's just say, when you consider the material costs, the labor costs, the shipping costs, all of your related costs, let's just say that jacket is truly worth $50 by the time they have all their costs subtracted out of it and what they need to make their profit. Then let's say that jacket at fair value is worth $50. Well, in the summer, what happens to that $50 jacket? Demand goes down. So, the price of that jacket goes down because people aren't clamoring for jackets when it's 80, 90, 100 degrees outside. So, that jacket could go to something way underpriced during that time period, like a clearance rack or a sale rack or something like that. It might end up being $35. Well, is it any less valuable? Not really. It's still the same material, still took the same labor costs, still took the same shipping costs, etc. Then, you've got winter that comes along and could possibly even drive up the price well above what is normal, because there's very high demand when for a jacket when the temperatures drop to 30, 20, 10, etc. And so let's say maybe the jacket goes to $70 then, and price could be, I mean, you've seen this in retail, so I'm giving you an example that everybody knows, but we're taking the stock element out of it. You've seen jackets in the summer that normally go for a baseline of a certain amount that's a true fair value of a certain amount. In this case, we're using $50. And you've seen those go on sale, and they become underpriced due to, at the time, there's negative sentiment towards a jacket in the summer. Who the heck wants a jacket in the summer? There's not an enticement to get it. There's not a near-term present need to get it. So the demand dynamic is down relative to supply, and it underprices that asset, which clothing is a depreciating asset, but it's an asset. So it's not a good asset because it goes down in value over time, but it is one. So and then in winter, demand can go high relative to supply, because everybody and their mama wants and needs a jacket, and so it can push the price to where it gets a premium for really what it could be worth in just medium, mild, fair climates where it's not too hot or not terribly cold. It might trade closer to its $50 value. So let's say it's 50 or 60 outside. You might see that come down and it trade closer to its fair value of what it might really be worth. But extreme conditions can really price up the jacket, and extreme conditions that are unfavorable for a jacket, such as hot weather, can bring that price way down. Well, stocks do the same thing. Sentiment here is extremely positive for jackets. Everybody and their mama wants one, and so that can push it to a premium or overvaluation, and everybody abhors them and doesn't hate them, but just there's no need, no compulsion to go run out and get a jacket at 35. Now, and again, due to negative sentiment towards it and low demand relative to supply. Now, those who are smartest with their money will many times get stuff out of season for the next season. And why are they doing that? Because they're trying to take advantage of this supply-demand dynamic of buying jackets in warmer weather for the future winter, so that they can pay $35 instead of $50 or $70. And they're buying T-shirts, when it's 20, 30 degrees outside, because, those, again, you probably wouldn't be at $50 for a T-shirt if you were at $50 for a jacket. I know there's $50 T-shirts out there, but I'm just using this arbitrarily. But that price for that T-shirt in winter would be far lower. So if you get them, in opposing seasons, you're paying far less for literally the very same thing. So for the T-shirt, it's still the same cotton or, materials. It's still the same costs, labor costs, shipping costs, etc. But the supply, demand, and sentiment dynamic can cause something to be undervalued or overvalued and not fair valued. And so I hope that helps you to be able to kind of understand why stocks could ever get undervalued or overvalued, and why they're not perfectly in sync. Because if you go to college or universities, they'll tell you that there's an efficient market theory, an efficient market hypothesis that says that stocks are always fairly valued, and everything known about a stock is always reflective of it, and so therefore the stock price is always correct at whatever it is at that time. And that's just junk. I've shown you the erratic, crazy behavior that just in the last week or two that I've lined out on some of our charts, and there's no way that the company was valued at that drastic of prices up and down in a near-term basis. So price is what you pay, but value is what you get. So price and value are not always the same thing. You could buy a jacket for $35. It's really truly worth $50 in regular conditions, and could be worth $70 in extreme cold conditions, and vice versa. You could really pay top dollar for a jacket because you're buying it last minute when it's so cold and you don't have a jacket and you need it because it's 20 degrees outside. You're going to go out there and pay whatever you need to keep warm, and so you're willing to pay a premium and pay up for what normally in regular times might be worth 50 and in the summer might be worth 35. And so it is the same with stock. So I hope that's a good example that helps you. I like to use some examples that are outside of the stock world to teach you about the stock world, because I think it helps people to understand. To me, a lot of people make stock investing way too complicated. They talk in a language that's way too complex. Like if you listen to the financial media, they spout off so much industry jargon that you really have to learn how to decode the language and decipher it. And I think they make it hard for a reason, so that they feel that you always need them and that it's above you and that you won't be able to understand it. But it's just simply not true. It's just explained in an overly complex fashion, I believe, so that you always think, well, that's too hard, and I need to have somebody, I need to pay them their fees for that. But it can really be relayed so much more simply than what they do. So, me as a teacher, I like to break things down to the lowest common denominator. If I can use a 50-cent word versus a $5 word, I'd just soon do it. And if I use a complicated word, just to get you acclimated to an industry term, I try to explain that term. So, excuse me, GLD is taking a dip. All metals today are taking a dip on the basis of there may be a China deal that's coming. There's talks in China and the U.S. of both sides ratcheting down tariffs, at the same time. But there's still no sign on the dotted line. Even if there is a sign on the dotted line, it's only a phase 1 deal, not really a phase 2 or 3 deal. And people also forget that markets are still overvalued. That means those markets are still going to correct, and as they correct, that's still bullish for gold, silver, platinum, palladium, all kinds. Well, palladium really is probably a bit overdone, but all three of our metal positions anyway. So so this could again go back further before heading higher. Might, may not. That might be it, and off to the races. Either way, like I say, we are in we could be in a 5-wave sideways consolidation, but it looks more like an ABC correction, but it's a little sloppy, choppy, so it's a little harder to tell. The corrective waves get a little more jumbled than the impulsive waves, which are the moves that are in line with the actual trend direction. So like see how it's a little more jumbled, and then see how distinct these moves are. So we're in that corrective phase right now, and we may not be done with that. We are in the bottom Bollinger Band, but we are a ways away from the 200-day moving average. Sometimes it can stay away from those averages for a while. Metals sometimes do that, or sometimes they can bounce back to them and head on up. So we are getting oversold again on RSI at the bottom Bollinger Band. So that's one reason why this could go back up, or it could close that gap with its major moving average before heading higher. We do still have selling volume notably lower, even with this decent size down move today. So still very bullish on metals and our metals positions. So next we've got FXB. The Bank of England just left rates unchanged. There were a couple of ones that wanted to actually lower rates, but they kept them on hold. So far it's kind of kept the pound kind of hovering. Just know, sure, this could do this, but it could come back towards a 50-day moving average that's a ways away from and head higher. That would be very likely. And then there's also, it could just trade and consolidate above this moving average for a while before heading higher. But I like it that the RSI is still climbing. The MACD downtrend was broken. It's still trending higher. Your selling volume had continued to dissipate, and your buy spikes are more predominant. So, I'm very bullish on the pound and see it going higher. I find it also interesting too now that you're having the pound head higher and you're having metals head higher against a rising dollar. So that's really a strong case scenario, because it's a bona fide pound move and metals move versus it just being a dollar weakness type of move. So so that puts me even more bullish on those than I would even normally be. EWW has been firming up here lately as it broke above. We had this three-way pullback and then this next push higher. So I believe there's still far more to go here, but the price is a little bit away from its 200-day moving average. We are still seeing it strengthen on its RSI. Its selling volume continues to drop down lower. It's MACD is flirting with breaking higher, trying to firm up. So like you see it heading, well, it's more like that higher low and then this higher low. You'd have to kind of draw it like that. But so all that's firming up. So of course it could do this, but could it do something like this before heading higher? Absolutely. But definitely very bullish on that. And again, this is another one where there's a lot of price shifting, but the value of these Mexican companies aren't shifting that quickly to where, here it's worth 46 and then, here it's worth 37 and then here it's worth, 45 and change. And I mean, price going all over the place, but yet the value of the companies within them are not changing near as quickly as price. So don't assume, because people assume price equals value, and it does not. And as a value investor, you have to, buy into that concept. You buy into the efficient market thesis crap, and then I don't even know why those people invest, because there's no values to be had according to to them. But we know that there are. That's why we've gotten great companies at great prices. That's why we've had great moves. I mean, it's a system that's been proven over the years. Some positions take a little longer than others. I think you're going to do better from LI going forward, because in this format and in our next format, it's not that the system has changed or has gotten any better, but the communication has gotten better with these formats. So I'm able to more accurately describe to you averaging down zones, which I kind of had to be a little more vague about in previous newsletters. I can have direct and quick communications with you. My buy signals can come out in real time for the buys, versus 3 to 4 weeks before it would come out in newsletter in previous formats. So that can make a big difference on returns. Just all kinds of things to where I believe with the communication and the message of the system improving and how quickly I can communicate with you as well, I think it gives you the ability to do even better with the same system being conveyed and communicated even that much more quickly and accurately. So I do believe your returns in LI have benefited because of that, even though the system itself hasn't changed. And I believe that as we carry LI on into the new site, the new format, which is progressing, by the way, I'm continuing to shift over 2 years worth of newsletters onto the new site, and then once that's done, I will test the payment side of it. We're making some tweaks on it right now on that, and then I may beta test with a person or two, and then we will basically flip the switch to where SeanHyman.com redirects to the new site. And once you see that happen, you can cancel with the Maven and re-sign up at the new site, which will be $17 a month. It'll be strictly a monthly subscription that can be canceled at any time, but we're doing away with annual subscriptions because it makes my income so uneven, because most people will come into my newsletter within a month or two or three, and then so their annual renewals are in that same time frame. And so, for a month or two or three, I'll make really good money, and then the rest of the year, it's having to disperse all that money throughout the year to make that fine. And I steward that fine, but I don't like, having to take 30 to 90 days worth of pay and stretch that over 12 months. So we're going to the monthly format exclusively. It'll make it smaller bite sizes for you, each, on a monthly basis rather than, all at once on an annual. And there's no contracts or no obligations or things like that. But I just believe that people will want to stay on because they see how the system works. It keeps them out of the potholes of overvalued stocks that they've been in before, which helps them to avoid a lot of crashes and helps them to take advantage of crashes because they know now to have cash to be able to measure risks, to be able to get into value stocks, to be able to get superior yields, and to delve into areas that they would have never have delved into before and profit off of sectors and areas that they would have never been in before because of all the media hype and fear surrounding a sector. So I think those are massive edges that you have in this service. So LPL broke its last ABC correction lower. We're in the next up wave, I believe. RSI firming. The selling volume continues to drop off. Buying volume picking up. MACD picking up. The downtrend in the MACD was broken again. Another bullish sign. So I'm looking for this to head higher. Now it could do something like that. Could we go back lower before higher, or could we go even lower before higher? Sure, we could, but I think one of these couple of paths here is most likely, and so I'm looking for our next big thrust to be higher, and so very bullish on this one over time. Then we've got BBBY. This is a prime example of price does not equal value. I mean, this goes from 19 to sevens to right at a penny from being 15. I mean, within just mere months. I mean, so what is this? 1, 2, 3, 4, 5, 6, 7-ish months, and it's had that wild a swing. And you're telling me the value of the company changed that much in that little time? No, it didn't. Fundamentals change slowly. Price can change quickly. So it's that 35, 50, and 70 example, that I gave with the jacket. So here it's hated. It's under, it's extremely undervalued, and it starts that eventually is recognized, and it corrects itself, and here it's doubled off of its lows. So could it consolidate sideways a while before heading higher? It could. But it could also easily close the gap on that moving average, and sometimes even overpassing, to the downside a little bit before heading higher. So just know, but I'm expecting the next, still for this to trend higher over time, going up to about the 2021-22 area, and then we may look to exit. So MACD still continues to firm up. You've got the buying spikes being predominant. Selling spikes continue to get lower. RSI heading higher overall. So just a lot of bullish signs there. So very encouraged by what I see there, and price can change very quickly. So the reason why you need to stay engaged with this is because these prices can change so quick. This went from 10 to 19 in a matter of about 90 days or more. This went from 720 to almost 15 in 60, 90 days as well. So if you're just occasionally checking in with us and stuff like that, you're gypping yourself. You're going to miss some massive returns, and you might make it to where you miss one rally up. And if you miss that, then you've got to wait the whole ride around till it comes back around to that again to just get the same return that we did, yet over a much longer length of time. So stay focused with us, because there's people that have already missed averaging down points on one of our last one or two ETFs, or excuse me, not the last one, but our next to last one, because we haven't had an averaging down level hit on our very last one. So let me clarify. And I think why? It's just it's lack of engagement, lack of checking out videos and things on a timely fashion, and because of not staying alert on that, it literally costs them dollars and cents. It literally costs them opportunity, percentage gains, and it's just a shame. Because I want you to squeeze the lemon as hard as you can. I want you to make the most money for your subscription fee that you can. My fee is the same, so it's no different for me. I don't benefit more, but I want you to benefit more because you can benefit more. So if I ever seem like I'm stern or harsh or this or that or whatever, I'm not being. I'm just wanting the best for you, so that because it's more money for you, for your dreams, for your future, for your lineage, for your church, for the kingdom of God, which means for eternity, because it helps people. The gospel is funded. That's how Bibles are printed, because money was spent to fund them. Missionaries are sent because money's given. Therefore, the gospel message happens because, and in part, because money is sent to the church. And the more that can happen, the more that affects the pace of souls being able to enter the kingdom of heaven. So it's a big deal, And aside from all that, just stewardship issues. If the Bible says we're faithful over little, God will make us rule over much. Well, little is relative. 1 million is little if for people who have 10 million, 100 million, but also people that have 10,000, 20,000, 30,000, and that's their little. If you're faithful of that, then you can be trusted, and God can entrust you with 100,000, 1 million, or whatever. But why should He entrust anybody with more if they're not faithful to what they've got? So what you're going to find is the more you steward the little that you have, whatever you consider that little to be, then you will find more money coming into your hands through stock appreciation, through dividends, through capitalizing on the returns better, through unknown sources of stuff coming into your life. It's unexplainable. I can't explain it, but I've just seen the pattern through the years of people who steward better. Money finds a way to them, and it's God doing it, because God doesn't give money to bad stewards. So the more, the better you, and I'm not saying it won't help meet your needs, but anything that is growing wealth, he gives that to good stewards. I mean, it's plain from that scripture that I just quoted. It's plain as day from the parable of the talents, because talent was not you play the trombone well. Talents were literally it was money. One version even calls that, instead of parable of the talents, the parable of the bags of gold. So gold coins. So it was literally money that was being talked about. So in our Western English mind, we think talent, we think something you can do well, but he wasn't dividing up something that you could do well. He wasn't saying put this on with the bankers so that it could have earned interest. Well, your talent couldn't be put on with the bankers to earn interest. So it literally was, monetary, and so we need to steward that well. And if we steward that well, then we'll be given more. And by the way, we'll be told, good and faithful servant. And so that's what we want to hear. So our, what we do not only with our soul is important, but also what we do with our money is important. I mean, it's very evident in the Bible. So here's the ABC correction on CAJ. This long wave C here ended here. So therefore that started our next up cycle. And again, it's near term, it's all over the place. 25s to 30, 30 to 25s, 25s to 2770. So it will be volatile, but you'll also notice that the selling volume is starting to dry up just a little bit. Little less. The MACD is perking up. RSI is perking up, so things are looking better there. But expect, whether on a daily chart or on a weekly chart, this stock is volatile. So don't expect anything less. So this stock can be down 4 or 5% or so for basically no reason, and it could just about be up that much for about no reason, just because it's a volatile stock. It just is. So just know that. So this stock could could do something like this, could do something like this, and then head higher, or this. Obviously this takes no emotional strength on your part hardly at all, but the sideways range does a little bit, the pullbacks do a little bit even more. The more you get comfortable in being mindful of fundamentals and valuations and things like that, and that you bought something undervalued and that you've got averaging down money in case it drops further, the more you care less about the day-to-day wiggles and squiggles, and the only ones that matter are when you finally reach it to your sell target to take profits. So very bullish on CAJ, and then we've got KHC. So this one is one that has perked up here lately, and I've been looking for that to happen. One thing is that it's broken above these highs here. It's also broken above its 200-day moving average and 50-day moving average. Now, it might possibly recoil back, and then and its next move be the one that actually sustains itself above the 200-day. We don't know that, or it could consolidate a bit before that happens. So any of those case scenarios are likely, because we are putting in higher lows and higher highs now. This was a higher low than here. This was a higher high than here, and a higher high than any of these right here. So 33.43 here. We were 32.73 here, 32.79 there. So a clear break to higher highs, which means more buyers coming in. And we don't just have to trust that. I mean, we can see that on the volume chart. We can also see the selling volume just really drying up and getting less and less and less. So MACD heading higher, RSI has been heading higher. So I'm looking for this to head much higher. So we've got our averagings in on that, and it's looking good for us. Ticker symbol E. So this one has been firming up here lately. Here was your latest ABC downward correction. You've got the price pushing above that, so this is completed. So we should be heading up overall. So the bigger move should be upward relative to the downward moves, but we will have corrections along the way. So so we could get something like this. We could obviously get the sideways action, and of course you could just head on up. But a lot of big buy spikes in through here, and yes, there is one big sell spike through here, but most of or a couple of them, but most of these are the big buy spikes happening, which are bullish. The MACD's been firming up, the RSI has been firming up. So I'm looking for this to head notably higher, but we might get a pullback or sideways consolidation before that happens. Then next we've got SLV. So again, just like with all of our metals positions, they are pulling back on the thoughts of tariff stuff being over said and done with, which again is an assumption and not a guarantee. But even if it is, and all is well there, and all that's a race, and can markets irrationally go higher? Sure, they can, but they're still overvalued. They would just be getting more overvalued and more due for a pullback. So again, we are in ABC correction lower after this. Just it's hard to say if this was the ABC correction and we're done, or if this was more like A and then this was B and then we've got more C to go before heading higher. Any of that's possible. Even with this pullback, selling volume is notably less. MACD is still higher. RSI is deeply oversold. So I'm looking for metals to have another big push higher, but they may drop more before they head higher. So just know that. But they are still trending higher. Notice gold and silver are still in an uptrend. So CHL up slightly on the day. This one, here's your A, B, C latest downward corrective move, which I believe is likely over. Once it comes above this line here, that's when it'll really be a lot more confirmed that it is. The selling volume is getting lower. The MACD is getting higher. In fact, we're real close to another buy signal there. RSI is heading higher. So I'm looking for this to start to head higher. But, could we do something like that first before? Yeah, we could. So anything like that's possible, any of these scenarios. But overall, I believe we're going to head notably higher in CHL. So very bullish on it. Then we've got PPLT, I can almost say ditto with what we've seen with gold and silver. So again, we don't know if this was ABC and we're done. If so, then this 82.40 is the lowest, and any pullbacks are higher than that when we go. Or could we be more of like an A and then a B and then a C, something lower before heading higher? That could happen too. So we don't know, but either way, you would still be in an overall uptrend with it as well. Just a very volatile one, and metals are volatile, particularly when they break out. So, but RSI is strengthening. The selling volume is dropping. Some of the big spikes have been buy spikes picking up. The MACD picking up overall. So again, things are looking good there. Then we've got XOP and SLX, and so XOP has so far anyway. And again, it's too early to tell for sure, but so far this looks like it could be a double bottom. We don't know that for sure just yet. We do know that this looks bullish, that this has broken this and tested and held here. That's awesome. It's nice to see this buy spike here. It's nice to see that the selling dropping some. It's nice to see this MACD firming up on the right leg of the double bottom or potential double bottom, and the RSI possibly being slightly higher there as well. So if this is a double bottom, then this should come minimally somewhere up in this 31, 32 area before it's all said and done. But it could do something like this first before doing that. It could it could come back and do something like that first. Obviously, if this is not a double bottom, you could even get some kind of lower low before heading higher, and that's always a possibility as well. So we had a closer averaging down that I strategically placed that way. It did hit, and many of you are in it, and a few of you missed it. And again, you should have a limit order set so that if it hits it and you're not around, it still fills anyway. You just make sure you got the cash in your account first to make sure that you can make good on the order so that it can fill. But so that if you average down, then that brought your average break even down from 22 down to 21.25, and then if so, instead of mildly profitable, you're even a bit more profitable. But it will even make all the more difference as it goes up here. Now, if this zipped really quick to the 26 area, and being that our average is 21.25, there would be a possibility of profit taking. But if it took a little bit, we may would let it go longer, go higher. We'll see. But nonetheless, I'm looking for that to go notably higher, and very very glad with how it's happened to have done even in the near term. We're not in stocks for what they do in the near term. If they go against us in the near term and they take a while to pan out, that's just normal stock mechanics and stock investing, and that's just how that works. Companies need more time to sell more products, deliver more services to increase earnings higher, to justify our higher stock price over time, and so and a collection of stocks being an ETF over time. So that's just how that works. But it is, nice occasionally when we do get some that pop for us near term or profit near term and things of that sort. But don't expect that to be a norm, and we're not more right when that happens, and we're not off our game, when that doesn't happen. It's just, when you do enough stocks, occasionally you will get some that will turn profitable for you quicker, and some that'll take a little more time. And we haven't done anything wrong or bad or missed anything if it turns profitable quicker, and then it drops to something new, lower low, and it takes a while to come around to our original, our ultimate, sell and profit taking point. So it's just, markets gyrate wildly, and some things come out of undervalued states sooner, some take a little longer, and the market determines the timing and the speed of that. We don't. So we just take advantage of its price discrepancies when they get way out of line with what something should be valued at. So we buy the jacket, in the summer at $35 rather than $50 or $70. So here you've had this latest three-wave pullback here, a run up, a higher low, and also a slightly higher high here at 37.74 versus 36.70, and we've even been as high as 37.04 in the day. So we've got a higher high and a higher low, but we are bumping against this moving average, and many times it won't, get above it and stay above it in the near term the first time it hits that in a while. So it wouldn't surprise me if we had some kind of pullback before heading notably higher. So a sideways consolidation around it and higher, or a dip down lower and before we head higher, could definitely be in the cards. I like it that the selling volume continues to dissipate. I like it that the MACD has been firming up. I like it that the RSI has been firming up. So there's all kinds of signs there, for that. I was looking at I thought there was another pattern there, but there's not. It's not clean enough. So disregard that, what I was going to say there. But again, very bullish on these positions. Some will profit for us sooner than others. It's like when a farmer plants a crop. Sometimes crops will grow to 4 feet, and sometimes in some years they grow to 2 feet, and sometimes most of the seeds they plant come up, and sometimes a lower percentage of the seeds they plant come up, and there's all kinds of variance in weather and soil and all kinds of stuff. But if the farmer is faithful in planting the seeds and doing his part, then which is the part that he can control, God brings about the part that he can't control: the sun, the rain, the weather, stuff like that, and combined with the two, you have a harvest. Some years will be greater harvest, some years will be less harvest. Occasionally you'll get a bad harvest, but if you do this over a big enough string of time, and if you store back some of the harvest for some of the good years, it helps you take you through the blights and the droughts and the bad times. And so there's a lot of parallels to farming and to stock investing, and it's the same way. There'll be some years that'll be banner years, and some years that might be laggard years, and some years that'll be so-so years, and you mix it all together, and you can have market beating returns and inflation beating returns. But and when it lags or is negative, it's not, is the system working any worse or not as good or not accurate or whatever. No more than the farmer not knowing how to, like when he gets a not so bumper crop or whatever, it's not that he didn't know how to plant a seed right, or how to till the soil right, or fertilize right, or whatever. He's doing the same thing. He's got the same system, the same setup. It's just that certain times will yield more and certain times will yield a little bit less, but yet they prosper over time. And the same it is with prudent stock investing. So prudent stock investing is not get rich quick. As a matter of fact, if you read the Bible, it even talks against get rich quick schemes. And who are some of the first sometimes to go for crap like that? Christians. And that stuff travels around the circles of their churches, and congregants get mixed up in it, and they don't seek out the counsel from the financial guys that are in their midst, because they don't even want to have a wet blanket thrown on their get rich quick fantasy, and so they throw good money after bad, and they throw it into crap, and they become poor stewards, and they have their wealth decreased, and so it's a shame. So hopefully that won't be any of you. Again, hopefully you are faithful tithers and givers to your churches, and that as you prosper the kingdom of God and your church, your local church, sees a piece of that as well. Because in the end, we all die. In the end, we all go to eternity, and you get to make your shot and your difference on this side of eternity on how it affects others. And one way you can do that is by stewarding your wealth and stock resources and assets wisely, so that you can help your local church, missionaries, food programs, the needy, etc., all through your local church, and help fund the visions of your pastors and help expand the kingdom of God so that more people can be saved. All right. Thanks so much for watching and listening, and God bless. Bye-bye.